Hey guys, Dave here, back with another video on investing. Looks like it's a pretty good day in the stock markets today. We're up fairly substantially, at least in a lot of the NASDAQ stocks I tend to track, and the broad market seem to be up as well, a couple percent maybe. Hope you're having a good day in the markets with your portfolio. Personally, I'm of two minds of this. On the one hand, I'm kind of happy to see my stocks go up. On the other hand, I do still want to add more Rocket Lab in the threes, and today we're up about 5% on Rocket Lab, and we're back into like 4.1-ish. So a little sad to see that in one way. In the other hand, I do own Rocket Lab, so I guess I should be happy that it's going up, but that's just the weird situation you're in when you're still trying to add more to a stock. Today, I am not talking about Rocket Lab or space stocks, which I know I talk about a lot, and I will continue to make a lot of Rocket Lab videos as they're one of my highest conviction names. But this is a video just about how you manage and create your portfolio, how many companies you hold, how diversified you should be. I think it's important for all investors. So, if you love Rocket Lab, I think you should still consider watching this one just to think a little about how you create your portfolio and how many companies you buy. So going forward, I'll be sprinkling in all sorts of videos on investing, as well as continuing coverage on my favorite companies. So stay tuned for all that. For now, though, let's jump over to the discussion. So I think we all know the old saying, don't put all your eggs in one basket. And what this basically means is, if you're walking and all your eggs are in one basket and you fall, they're all going to break. Whereas if you have a few different baskets, a few different trips, if you fall, it's not the end of the world if one basket falls. This basically applies to stocks in that, if you spread out your portfolio and one stock investment fails, one thesis fails, the others will still theoretically perform well, and you'll be okay overall. So most investment professionals actually agree that although it doesn't guarantee against loss, diversification is the most important component of reaching long-range financial goals while minimizing your risk. For many years, financial advisors have recommended building a 60-40 portfolio, so 60% of your capital is to stocks and 40% is to fixed income investments like bonds. Personally, I'm not a big fan of bonds. I used to have some exposure to them, but especially at a younger age, I'm comfortable going 100% stocks nowadays, and just selling all my bonds. I do think they have a valuable place, especially if you're someone who's maybe already retired. You don't want to deal with quite so much volatility. There's definitely nothing wrong with bonds. There's a place for them for sure. So the most conventional view argues that an investor can achieve optimal diversification with only 15 to 20 stocks spread across various industries. Other views disagree with this, and they say that 30 different stocks are the ideal number of holdings. Now, if you do hold ETFs, you can actually diversify yourself with as little as one ETF. You could buy something like the VEQT, which holds stocks inside of it across all sorts of industries, all sorts of countries, and it's extremely diversified, just tracks the overall market for a low management fee. I do hold that in my portfolio as the safer section of my portfolio, and will continue to hold that while I have fun and try to go for bigger gains in stocks. So personally, I've actually come to believe that the biggest advantage an individual retail investor can gain is becoming an expert on a smaller number of companies. As I said before, I was buying too many with only a surface level knowledge. There's no way you can maintain an extremely deep level of knowledge on 30 plus companies and outperform people who do this full-time for a living, especially if you're like me and you have a full-time job as well, and you have a life that you have commitments. You just don't have the time for it. You'll pull your hair out. You'll get extremely frustrated trying to do it. So I've really changed my thinking on this, and I've decided that the way to go is research fewer companies to extremely deep level and grow a high level of conviction in those companies and then have a smaller number, invest bigger in them. That's why I've been focusing so much on Rocket Lab, trying to grow at an extremely deep level of knowledge. As well, I follow Tesla extremely closely. I have a large position in them, and I'm starting to consolidate some of my positions into a fewer number of stocks. Basically, we're trying to hit home runs with a fewer number of stocks and not just buying a ton out there and just hitting, singles or bunts, if you understand the baseball analogy. So, as I said, a few years ago, I did get carried away and invested in way too many companies with way too little knowledge in those companies. And I was spread too thin. I couldn't follow any of them as deeply as I needed to really understand the company and be confident in them and know where their earnings were going. So I was basically trying to take shots in the dark, and it didn't work out too well for me. So let's take a quick look at my portfolio as it stood in November of 2021. So here we have my former portfolio. First thing you can see is this is a pretty long list. This is definitely not 10 companies. I've gone through sort of different phases in my investing career, and there's kind of remnants from different phases in here. But just to go over the list of companies we have, and I'm not trying to brag here or anything, there's many people on YouTube with way bigger portfolios than me. I'm just trying to show how I was spread too thin, and this is something you could run into yourself. So I had Algonquin. This is a utilities company in Canada. BCE, that's a cell service company. Brookfield Renewable is a ETF with renewable projects. PZA, that's a pizza restaurant company. RBNK, this was actually a bit of a great trade for me. That is a Canadian bank ETF. But I bought it on margin right after the big COVID crash. I just saw that, these were safe big banks paying 6% plus dividend. My margin interest rate was only 1.5 at that time. So I would just make money every month. I hold it, and eventually they would come back, which they did. So I ended up making about $20,000 on that off of money that wasn't actually mine to begin with. But I had continued to hold it since then. Ruby and RUD are both American ETFs, holding banks and things of that nature. TELUS, that's another cell phone company. Then we have more ETFs holding various industries and companies. We have Very Good Food, which is an extremely speculative company, kind of in the plant-based food industry. More ETFs, more ETFs, more ETFs. I see a lot of ETFs. I used to be an ETF investor, and really, if you're going to buy ETFs, I think you should consolidate these down into a few. But, I had gains over the years, and I didn't want to sell to incur the tax bill. So I just kind of continued to hold them. And as my thinking on ETFs changed, I just had more and more. Now, of course, we have ARK Innovation. Everyone got into the hype of that one a few years back when it went absolutely crazy. A few more ETFs. ZQQ is a tech one as well. These are all on the Canadian side of my account. Now, on the U.S. side, we had Apple, Airbnb, Autodesk, which is a software company, Amazon, Algonquin, as well as both Canadian and American. Beyond Meat, probably needs no explanation. Coinbase, CRISPR, Corsair Gaming, Cisco, Disney, Etsy, Facebook, Google, different class of Google shares, Intel, Microsoft, Netflix, NVIDIA, Palantir, PayPal, Qualcomm, Shopify, Square, Teladoc, Tesla, TTCF, Tattooed Chef, that's another plant-based food company, Verizon, we all know Verizon, of course, Walgreens Boots, it's a pharmacy company in the United States, as well as Wynn, which is a casino company. They are operating in Las Vegas, in Macau, and in Salt Lake City. And then, of course, Zillow, the semi-disruptive real estate company. So as you can see, just a massive number of companies here. And how is anyone going to follow each of these closely and know exactly if they should continue to hold or sell or buy more? I mean, it's just impossible. Sometimes when you hold a stock, you have to think that every day you don't sell it, you're actually making a decision to buy it. because you're not selling it for that price. So theoretically, you're actually making the decision to buy it at that price. You're willing to pay that price for it. So every day that I held these companies, I should have really for each one been comfortable with the valuation and happy to continue to hold it. And there's just no way that I could, right? So what I'm trying to do now is consolidate this down into 10 or less companies while I continue to hold broader index ETFs for diversification and safety. So my safer money for my retirement and stuff like that, I don't want to risk in more speculative companies. That's in the ETFs, and I want to try to keep a certain amount in that. And then I really want to focus down 10 or less companies that I really believe in, that I really know extremely well, and I'm really able to stay current on them. So what I've done currently is I have sold recently Corsair, Zillow, Disney, Autodesk, Beyond, Intel, Verizon, Walgreen Boots Alliance, TELUS, Pizza, and RBNK, the Canadian Bank ETF. And I'm not saying these are bad companies, they're bad stocks. All I'm saying is that I needed less companies, and they weren't my highest conviction name, so I'm really just trying to make a more lean, more efficient portfolio in higher conviction names. So what did I put this money into that I sold all these companies for? Well, mostly two companies, Rocket Lab and Tesla. Those are the two that I follow the most closely. I'm pretty high conviction in both of them, and I've been adding. So added to both of those fairly large positions, and I'll probably continue to do so. I'm not done. You saw that huge list. We have a long ways to go here, but we'll keep at it. Now, this was extremely difficult for me for a few reasons. One of them was that it's always rough selling at a loss, and we've had a rough year on the markets, so many of these stocks were at a loss. But one way you can look at it is that while these companies are at a loss, that loss is, in a way, it's an asset. Because if you sell at that loss, you're capturing the capital loss, and you can put that against any future capital gain taxes you'll have to pay to cancel it out. So let's say you own a company, it goes way down, and you continue to hold it, and it goes way back up. And sure, that's great. You're back to break even. Now imagine you sold that company and bought it back and capture that loss. Now you have another company you sell, and you have a huge tax bill. You don't have to pay it anymore because you captured that loss, even though it's just a paper loss, really. And it's the game you have to play with the tax companies. So yes, it's a little sad that I sold some of these companies for a loss, but the companies I put the money into, I have been hit just as hard by the recent market conditions, and I'm even more confident that they'll do better in the future. So I captured those losses. And by the way, another strategy some people do, you might want to consider, is say you've got a big loss on a company. Maybe it's an airline, maybe it's in any industry. You want to capture that loss, but you still believe in this area going forward. So you sell that company. You have two options. You can buy it back in 30 days. That's enough time to lock in the loss. Or you can buy another company, another fund that trades very similarly and almost the same. So I could sell one airline, I could buy another airline, I could sell one tech stock, buy another tech stock, or same it goes with ETFs. There's 100 S&P 500 ETFs out there, so I could sell one and buy another, something like that. Just something for you to take into account when you make these trades. That's pretty much it for what I had to talk about today. Let's head back and wrap up the video. So yeah, that's my sad story, guys. Well, perhaps not sad, but committed to being completely open and transparent with you guys on what's going on with my portfolio and what I'm doing, what I'm learning. This channel was made to kind of be a learning opportunity, a learning journey, and I share what I learn and how my thoughts change as they change. Really interested to hear, how do you build your portfolio? How many different companies do you hold? How many different ETFs do you hold? Are you comfortable holding all in one company? Do you have 10 or more, 20, 30? Let me know down in the comments below. I'm interested to hear your thoughts on the matter. Also, of course, there's some other forms of investment, such as real estate, but I'll probably get into that in a future video. And I will be back with another Rocket Lab video very soon, so if you enjoy those space videos, keep tuning in, and I'll see you next time. Thanks a lot, guys. Bye.